Well, that's an eternal rule, like the law of gravity. What goes up must go down. In the financial markets, it really works. The point of all this is don't buy funds on the basis of past performance because it's not going to continue, or it's only the extraordinary case when it's going to continue. So people tend to, as I mentioned earlier, put their money into these big winners, and then down it goes. They pick the high because that's when the fund looks the best. I've taken 8 of the best known and most successful mutual funds of the modern era, and I've charted their return year after year, cumulatively against the S&P, and every fund looks the same, although all the time periods are different. The fund goes like this, and then it goes like this, over and over and over again. You see this in the big winners of the age. They go away, their managers leave, even the good managers might get fired, the bad ones retire. There just doesn't seem to be any permanent way to beat the stock market. And when, for example, growth does better than value, you want to put your money in a growth fund, and then value does better than growth. So when you say, I ought to buy this fund, I can tell you where you are on that line, right at the peak. And when the temptation is overwhelming, you put your money in and then are disappointed thereafter. Time is your friend, the miracle of compound interest. And when you invest over 20 years, 30 years, 40 years, 50 years, for today's young people, an investment lifetime is probably 70 years. Their life expectancy today is, if you're 20, is probably 90. And then you're going to be investing after you retire, of course, and presumably that's in your 60s or 70s for some people. And
not you, but
not me. That curve is just a sweeping curve. It's the miracle of compounding returns, and it pays off hugely. Albert Einstein called compound interest the greatest financial miracle of all time, or something like that. So take advantage of that. Focus on the long term. Time is your friend. But if you get distracted by the ups and downs, mostly by the downs, people respond much more nervously to downs than they do ebulliently to the ups, although that happens too. But impulse is going to get you in and out of the markets. Think about this. When the market is low, it's low because people like you are really worried. That's a good time to buy stocks, essentially. And if you're ebullient and feel very wealthy and want to buy stocks, that's at the high. Whereas if you're discouraged and selling at the low and aggressive in buying at the high, your money isn't going to last very long. Buy right means diversify, but you're diversified, so the intricate ins and outs of the market, steel stocks are doing better, or energy stocks are doing better, or healthcare is doing better. If you own the whole market, you get your share of all of that. That's the buy right. And the hold tight, and that is, when you get these periods of adversity and fear and greed, don't do anything. The bagel and the donut is a talk I gave years ago. The bagel is nutritious, good for you, while the donut has a certain sweetness. So long-term investing, holding on, is the bagel, and short-term speculation is the donut. Just a way of visualizing which you want, which is the best for you in the long run. And picking stocks or funds, finding that elusive needle that will give you what you think you want in the future is very difficult. We all know the metaphor of finding a needle in a haystack. It means forget it, it's not worth trying. And I would argue the same thing here. Own the haystack means own the entire U.S. stock market or the entire world stock market. Everybody has different ideas about that. Don't do anything once you get the haystack. No more looking for needles. I mentioned to you the magic of compounding returns over the long term, the mathematical magic of it. The problem we have in our society is that magic, on the record, is overwhelmed by the tyranny of compounding long-term costs. Be aware of that. Well, the basic argument there is that inflation, which you have no control over, eats away at the value of your dollars. You may think you're being safe if you buy a bank CD or an equivalent instrument, and let's say over 10 years. That instrument's going to lose 30% of its value conservatively over the next 10 years. They'll have a little bit of interest to offset that. If the dollar is worth 30%, which is roughly 2.5% per year in inflation, that's gone. You've taken a big risk by, in effect, speculating, for the want of a better word, that the dollar will remain unchanged, and it never has. And I don't think in our lifetimes it ever will. Maybe sometime. But so there's the big risk. So when you look at, say, stocks and bonds, stocks at least have a fighting chance to overcome the ravages of inflation. And the way I look at it, I've got some math behind this, because with a dividend yield of stocks about 2% and potential earnings growth should be in the range of 5%, stocks should give you about 7% over the next 10 years. Gross, before cost, before anything. That's a fairly conservative number, but I think it's realistic. And bonds should probably give you about 2.5%. So if you think about inflation, there's 2.5% inflation. The bond gives you 2.5%. You're doing a break-even investment over the next 10 years. You need more than that if you're going to build a retirement fund. Well, when we tend to look back, we tend to look at the kind of returns, the kind of economic environment we've had. And right now, today, one of the best examples is returns on stocks. The historical return of stocks is 9%. Why is that? It's so obvious. And that is that 9% over 100 years is 4.5% dividend yield on stocks and 4.5% earnings growth. 9 total return from investment. So when you go through the math, you'll see that the future return is going to be 6.5% or 7% compared to history. Don't listen to history. It's interesting, and it may rhyme, as Mark Twain said, but it doesn't repeat itself. The fox knows many things. The hedgehog knows one great thing. And what the hedgehog knows is that all of this fooling around out there does you no good at all. Own the market. And the fox, oh my, are they smart. They're smarter than all the hedgehogs put together. Go down to Wall Street and talk at all that immensely wealthy brain power, but of course builds nothing because they're competing with other brain power. I'm not saying brain power is wasted. I'm saying the average brainiac is average compared to the other brainiacs. So they can't win. We know that. You know, all the secrets. I've got a tip for you. Buy this, sell that. Now, that's the fox thing. A foxy way to beat the market. Doesn't work. Index fund, in fact, is an act of extreme boredom. If you don't peek, if you don't look, that's in your interest not to look. Why open that 401k statement or your IRA statement every quarter and say either I'm rich or I'm ruined? Throw it in the wastebasket. Don't let yourself get deterred by market changes, by gossip, by CNBC, whatever it might be.